but an official welcome to everyone. My name is Raquel Reddy. I'm the Vice President of Community Development here at NCST, and I'm going to make some quick introductions for my other colleague that you see here, Jenny Brown. Jennifer, or Jenny, is our policy manager here at NCST and is based in DC, and Jennifer will actually be providing us with Sharon's we'll be introducing Sharon. So before we do that, I do want to make sure that everybody that's here is here for the right impact briefing. We will be talking about the case for reform, the Federal Home Loan Banks, and housing. And so we will be asking for any questions that you have, that you place in the Q&A and the chat. We will leave some dedicated time to answering those questions after the presentation. And we will also be providing you with some of our own legislative and regulatory policy updates towards the end of the call. So with that, Jenny, please feel free to introduce all of us to Sharon Cornelissen.
Yes, thank you so much, Raquel, and Dee, for the warm welcome. I'm pleased to welcome our guest speaker, Sharon Cornelissen. So Sharon is the Director of Housing for the Consumer Federation of America, where she advocates on behalf of American consumers for fair, affordable housing and equitable mortgage lending. She brings over a decade of experience as a housing researcher who is passionate about promoting affordability and racial equity in homeownership. Prior to CFA, she worked as a postdoctoral fellow at the Harvard Joint Center for Housing Studies, where she published research briefs and advocated to address contemporary housing discrimination in Massachusetts. During her PhD in sociology from Princeton University, she lived in Detroit and firsthand observed the challenges of homeowners amidst neighborhood decline. She also gained expertise as a tax foreclosure prevention activist in Detroit and interned at the Detroit Land Bank Authority. Her work has been featured in local and national media and is published in academic journals, drawing on 3 years where she lived and became a homeowner in one of Detroit's most disinvested neighborhoods. She has a book forthcoming about everyday life in depopulated cities. Welcome, Sharon. Oh, Sharon, I think you're muted right now.
Here we go.
Perfect.
All right. Thank you so much, Jenny. I really appreciate the kind introduction, and I really appreciate being here. I'm a big fan of NCST, and excited to work together more. All right. So, as many of you know who are here today, over the last year, the FHFA, led by Director Senator Thompson, has really prioritized Federal Home Loan Bank reform. Members of Congress and the Biden-Harris administration have also indicated that reform is one of their priorities. I lead the Coalition for Federal Home Loan Bank Reform, which is a national coalition of 12 national housing advocacy organizations. And together we believe that the home loan banks have really strayed from their mission to help support affordable housing and community development in this country. Instead, over time, this system has become more focused on optimizing profits for their members, who include insurance companies and banks, rather than on really leveraging the system and leverage its full capacity to move the needle, especially in today's housing crisis. So I'll first offer some background on federal home loan banks, and then I'll go deeper into some reform priorities. So what is the federal home loan bank system? The fact that you are here, I'm assuming that you know a little bit about it, but most Americans have never even heard of this system. The home loan bank system was founded in the depths of the Great Depression in 1932. It was chartered by Congress. And at the time, lenders' ability was very much limited by their access to consumers' deposits as sort of the capital to originate a mortgage. At the time, they didn't have securitization or secondary mortgage markets yet, right? So liquidity was a big constraint for mortgage origination. So the Federal Home Loan Bank, by offering these sort of discounted by cheap advances to their members in exchange for housing collateral, especially mortgages at the time, like single single-family home mortgages solved that liquidity problem in the 1930s and injected more liquidity in mortgage finance. Today, the system persists 92 years later. Of course, our housing finance system is very much transformed, but the system remains more or less the same. They collectively issue debt for the banks and insurance companies that are their members, and they are a GSE, so they're a government-sponsored enterprise, which allows them this capacity to borrow so cheaply on capital markets. Indeed, they borrow at rates right now that are close to the what the Treasury pays for debt. Currently, they pass on most of this subsidy to their members directly as cheap loans that are also called advances. So what does the membership look like right now for Federal Home Loan Banks? The thrifts and insurance companies were among their first members, which reflected who was doing mortgage lending in the 30s. Big changes were made after the 1980s when the savings and loan industry collapsed. And as of 1989, membership eligibility was expanded to include commercial banks and credit unions, which now actually comprise the largest share of its membership. And since 2008, CDFIs have also become eligible to become members, although they still, of course, comprise a small share of overall membership. So, you know, what do Federal Home Loan Banks do? I already spoke a little bit about this, but they have a very simple business model at heart. I sometimes also call them a type of bank for bankers and for insurance companies. Their main line of business is to extend cheap debt, so below market rate loans, also called advances, in exchange for any form of collateral that's real estate related. So unlike the 1930s, this no longer just means whole single family, whole mortgages, but we also see a lot of use of MBS, mortgage-backed securities, as collateral, as this is something that many of their member institutions already invest in anyhow as part of a balanced portfolio, right? So they're using this to kind of enhance their yield on these assets through access to Federal Home Loan Bank advances. The system is cooperatively owned by its members, so members are also stockholders, and as a result, the members receive kind of two main benefits, kind of double benefits. Not only do they get access to steeply discounted advances based on sort of the GSE status of the Federal Home Loan Bank system, but they also get paid out dividends every year based on their stock holdings in the Federal Home Loan Bank system. So I mentioned the word GSE, government-sponsored enterprise, a few times already. So what does this mean, right? What is a GSE? Fannie and Freddie, although they're under conservative right now, are examples of other GSEs. So GSEs are chartered by Congress, and they're given unique regulatory and tax benefits in exchange for meeting unmet credit needs that could not be met by a private company alternatively, right? So we need the GSEs because the credit needs that they fulfill are not being fulfilled by the market at large. So as a GSE, the Federal Home Loan Bank system enjoys a range of special advantages. So this includes a $4 billion Treasury line of credit. They're exempt from all federal, state, and local income taxes. And they also enjoy what's called a super lien status on debt. So that means that that buyers of Federal Home Loan Bank, this means that if a member financial institution fails, they have first dibs on collateral and other assets if needed to fulfill their outstanding credit. So they get first dibs even before the FDIC and taxpayers, right? So this means that they run virtually no risk of losses. And all these sort of special GSE kind of benefits together result in what's called an implied federal guarantee on debt. So this means that buyers of Federal Home Loan Bank debt expect that the federal government stands behind this debt and will not let the system fail. It is the Congressional Budget Office estimated that this sort of implied federal guarantee alongside the sort of broader GSE status of the Federal Home Loan Bank system translates in about 40 basis points, so 0.4% discount on their debt. So adding all these advantages up, the Congressional Budget Office estimated that this adds up to a government subsidy of around $7.3 billion in 2024. This subsidy does not show up on congressional appropriations on the budget, but it relies on these sort of implied federal guarantees, including the potentially high costs of public bailouts were the Federal Home Loan Banks to fail. Without GSE status, they would not receive any of these benefits, right? So the government subsidy kind of goes through this GSE status. So what does the public receive in return for $7.3 billion in these sort of indirect government subsidies? In fact, at the time, currently they receive very little in return. So on the left side of this figure, we see the different types of sources of these public subsidies. So regulatory exemptions are worth around $100 million according to the CBO. Their tax-free status, $800 million. And then this 40 basis point discount on Federal Home Loan Bank debt is worth around $6.3 billion a year. So this adds up to this $7.3 billion. And then on the right side, we see what they're spending it on, sort of their main kind of big expenditures. So in 2023, they paid out nearly $3.4 billion of their profits as membership dividends. It was an extremely profitable year for them, so they paid out $3.4 billion in dividends. By contrast, they only spent $355 million in mandatory AHP, Affordable Housing Program contributions. So they paid out almost 10 times as much in dividends, just going to their members, to banks, insurance companies, than they paid out to the public, as affordable housing programs. So very much more, went to, like 10 times as much went to membership dividends as to affordable housing programs. So, you may say, well, Sharon, are you cherry picking? 2023 is a year. So in this slide, we see that, in fact, this has been a trend since at least 2001. Dividend payouts very much exceeded AHP contribution every year since 2001. So at least 4 or 5 times as much was paid on dividends as on affordable housing program contributions. So this really, goes against the sort of mission that they were founded on and their congressional charter as a GSE. So the bulk of the $7.3 billion in government subsidies goes towards member benefits and profits rather than to support public benefits. So I want to give a little bit of background on AHP because I've mentioned it a few times now. So the bulk of affordable housing program contributions right now go to 2 main programs. So first of all, towards DPA, down payment assistance programs. On average, these programs support around $8,000 in cash assistance to home buyers, especially LMI or first generation home buyers. And then 2, AHP is spent on gap financing for LIHTC and other affordable housing developments. This includes both units for rental and for owner occupants, but it's very much sort of, when I've talked to developers, they say it's the last financing that comes in, the first that comes out. It's often difficult to secure, and it only offers a tiny little gap at the very end. So on average, around $12,500 per unit. And then finally, a small portion right now also goes to home rehab grants, but it's a very small program. So 760 of those across the entire system in 2022. So we think that this is a good start, but of course, looking at the numbers in the previous slides too, much more can be done. We need right now only 10%. Congress only requires the Federal Home Loan Banks to spend 10% of their net income every year on AHP. In the last 1 or 2 years, based on the intense scrutiny that the Federal Home Loan Banks have received, from the public, from FHFA, and from members of Congress, they have been upping their voluntary affordable housing contribution. So this year, they're aiming to contribute another 5% in addition to the 10% minimum, so 15% in total. But we really think that there's a lot more capacity there, and it should become mandatory, not just sort of optional based on the level of public scrutiny that they receive in any given year. So, the coalition also believes that AHP will always remain a limited way in which this system, this GSC that was, meant for housing finance, can really contribute to kind of housing goals today. So something that's less talked about is the potential of leveraging Federal Home Loan Bank's retained earnings for affordable housing and community development goals. So in the graph here, we see the rapid growth, the steady growth of retained earnings of Federal Home Loan Banks over the years. So every year they, spend a certain amount of money of their net income on dividends and then a smaller share on AHP. But they had, additional profits that were sort of left over, and they were kept within the system as retained earnings. So the blue line represent that growth in retained earnings. So they've added billions of dollars every year to this capital stock. So this also demonstrates that, in fact, the Federal Home Loan Banks had more than enough financial capacity to devote more to AHP if they had wished to do so, right, over this period. It also means that the growth in retained earnings means that the system is well beyond the safety and soundness requirements of the FHFA. So this is from their own data, and also this information can also be found in their financial statements. So by the first quarter of 2024, the system held 1.8% in excess regulatory capital. So this means that their minimum capital requirements were $50 billion, but they actually held on to $73 billion, meaning that they held on to $23 billion in excess regulatory capital. Right now, the system uses pretty much all of this amount just as sort of as an investment strategy. So they're supporting an investment portfolio that generates even more profits for the system. And as we know, most of these profits actually go to benefit their members, right? They're being paid out as dividends, for example. But we believe that the surplus earning, these $23 billion in surplus capital is a great opportunity to really leverage that amount to do more for housing and community development. For example, some of this capital could be used to support a loan fund that could help finance affordable housing developments directly, right, rather than just through that gap financing. This loan funds could also help finance unconventional mortgage products that are currently not supported as much by the broader market. We also believe that some of this $23 billion in capital can be set aside as a credit enhancement tool for a membership incentive program. For example, some of this credit enhancement kind of capital can be used to offset risk that currently, means that CDFIs and maybe small community banks as well, they're being charged more to gain access to advances. But this credit enhancement tool could sort of offset that risk and lower the borrowing rates for these kinds of institutions, and help support more mission-based activity through advanced lending. So that means that, advances would be more competitively priced based on mission achievement rather than just sort of based on the risk that's evaluated by the Federal Home Loan Banks. So this brings us to the issue of reform. As you all know, reform is in the air. There's two main players that really have helped put reform on the national agenda. One of this is Director Sandra Thompson of the FHFA, who's really made this her priority, and also Senator Cortez Masto of Nevada, who's really pushed this issue in Congress, specifically so in the Senate. So 2 years ago, the FHFA started a wide-ranging national discussion on the home loan bank system, and they were talking to hundreds of stakeholders across the country to get their inputs on what the system is like right now and what it should look like. Based on this effort, last year, the FHFA published a wide-ranging report, in which they put out key recommendations for reform. I think it's around 32 different recommendations, and it includes both sort of regulatory actions that is within the authority of FHFA, as well as changes that would require congressional approval. So, what should, according to the Coalition for Federal Home Loan Bank Reform, which I lead, what should federal home loan bank reform look like? Right, there's a lot of ideas out there. First of all, and this is recommended both by the FHFA as well as by the Biden-Harris administration. They recommend that Congress raise mandatory AHP contributions from the current 10% of net income every year to 20%. As a coalition, we believe that these contributions could be raised even further to a mandatory 30%. We think it's more than reasonable given the profitability of the system and sort of the growth in retained earnings over the years, as well as how much annual is being spent on dividends right now, right? We think 30% would introduce a more equitable balance between kind of public benefits and these private profits. But FHFA also has a lot of authority to implement reforms. So first of all, we think that they should clarify the mission of the federal home loan banks as not being just about liquidity, right? It's not just about providing advances to their members for any purpose that they see fit, but it's really providing liquidity for housing and community development, right? As evaluated through the types of collateral that they put up and the broader types of activities that they engage in as institutions that are housing and community development related. Second, we think they should make it much easier for some of the players, some of the members in the system that do already most for the communities that they're located in to really benefit from advances and other programs from the Federal Home Loan Bank system. Specifically, we're thinking about a membership incentive program that would reward CDFIs and community banks in particular and other members that are very much focused on mission to get access to more attractively priced advances. As I mentioned before, we think a credit enhancement program, capital set aside for credit enhancement would help make such a system possible without taking on too much risk. We also not only want to make AHP bigger, but also more regional, more relevant and sort of responsive to regional housing needs. There's another RFI that I will talk about in a bit that's also very much about, well, how can we make sure it's easier to access AHP and it's really moving the needle, for example, for affordable housing developers to like make their projects work rather than just offering this tiny amount of gap financing at the end. Overall, as I said before, we want to leverage the Federal Home Loan Bank capital stock for innovative programs, such as through a loan fund or through credit enhancements. And overall, we want to ensure that the $7.3 billion in public subsidies the system receives every year actually, go towards affordable housing needs. That there's a right balance between kind of public subsidies and public benefits. All right, so the FHFA currently has not one, but two RFIs out, where they're soliciting feedback from the public on how we can make the system even better. The first one, which is due July 15, is really about the mission of the system. They're asking for input on mission. So they're asking what the mission should be. So how, benefits of the system should be distributed to members based on mission alignment, and what the right balance is between public subsidies and public benefits. So I encourage you all to look at this and to see if your organization perhaps could submit a short comment letter, specifically around mission and how it connects to housing. But the Coalition for Federal Home Loan Bank Reform is also finishing up a detailed comment letter that goes at these issues, and it will be available for broad sign-on. So I hope that NCST perhaps can distribute this to, so you can sign on if you wish to do so. And then the second RFI is on the affordable housing program. So it just came out last week. So this RFI includes questions such as how the AHP application process can be made more effective and efficient. How does applying to AHP compare to applying to other funding opportunities, for example, to get gap financing for affordable housing construction? And how could the AHP process, the application process, be simplified? So this is an issue that's been raised repeatedly to us by local stakeholders and organizations that deal with AHP funding. So I think it's a really important RFI as well to respond to. So if you have experience with AHP and you have ideas for how to make it better, I think this is a great opportunity to kind of share your thoughts with FHFA. All right, so this was all about sort of what the FHFA is doing right now and what they're planning. But there's also opportunity for congressional action here. There's two key issues that would need to pass through Congress. First of all, the question of who should be a member of the Federal Home Loan Bank system to begin with. You could ask, for instance, if life insurance companies should still be members today, given that they no longer originate home mortgages and have a very tenuous connection to housing finance at all. Right now, they're mostly just using access to Federal Home Loan Bank advances as a way to for yield enhancement. It's called yield enhancement on their investment portfolio. So it's a little unclear how that promotes affordable housing exactly. And then the second thing is AHP. So the raising mandatory AHP contributions is something that would have to be passed by Congress. The Biden-Harris administration has indicated that they support raising AHP from 10 to 20%. And actually in a public talk just earlier this week, Secretary Yellen of Treasury also called upon the Federal Home Loan Banks to raise their AHP contributions from 10 to 20% already on a voluntary basis. She's calling upon them to do so specifically to kind of help move the needle on our housing supply crisis that we're really facing right now. So I think that's great. This is a great initiative, and I hope that Federal Home Loan Banks are listening and are upping their voluntary contributions to 20% already this year. But to make 20% AHP mandatory, again, this would be something that Congress would have to change. We're also seeing some support, especially in the Senate, for this, mostly in the work of Senator Cortez Masto, as I mentioned before. In the last Congress, she introduced the FHLB Mission Implementation Act, which also includes that 20% AHP proposal. And another vocal supporter of Federal Home Loan Bank reform has been Senator Warren, including through a letter to the FHFA. All right, so there's a lot of information, but our key takeaways that we want to bring home back to the home loan bank system, right? Realign the system with our housing finance needs today. There's a lot of inertia in the system. It's a 92-year-old GSE that was that was chartered based on the housing finance system of 1932. So there's a lot that sort of persists in the system. But over time, because of this inertia and because of the ways that the housing finance system has changed, it really is no longer moving the needle on our affordable housing needs, and it's instead become more and more just about maximizing profits for their members. And we think it's unacceptable in sort of the housing crisis that we find ourselves in today, where millions of Americans are priced out of homeownership altogether. Renters are facing severe cost burdens, and homelessness is on the rise as a result of rising rents and home prices as well. We think it's unacceptable that this GSE is not living up to its mission, and that these $7.3 billion in public subsidies are not going to public benefits. So we're hoping that reform could help the Federal Home Loan Banks really prioritize mission in their staffing, in innovative programming, in leveraging their retained earnings, and maximizing AHP contributions as well as impact. So that was it for me today. Thank you very much for your time. You can read more on Federal Home Loan Bank reform on the Coalition's website, FHLBreform.org. And I'm happy to hear any questions and hear, in the chats, hear your experiences with working with FHLBs as well. All right.
Sharon, thank you so much. And we do have a couple questions in the Q&A. So for folks who are here and listening, please continue to put your questions in the Q&A or any comments in the chat. I'll start with question number one, Sharon, for you. And so, is the information provided for the Federal Home Loan Bank's affordable housing programs only for those explicit statutory programs? Second, so there's a two-part to that. Do your numbers include the bank's vast voluntary programs that support issues outside of the statutory programs?
Yeah, that's a great question. So since 2001, banks, the Federal Home Loan Banks, have really done the bare minimum, like voluntary programs year over year really were rounding errors. It was like 0.1, 0.2, 0.3% voluntary a year. But as I said, only since the intense public scrutiny have they really tried to step up their game. So last year they made around 2.4% in additional voluntary contributions. And this year they're aiming to achieve 5% of voluntary contributions on top of that minimum of 10%. So I think it's great. I think it's important to give them credit for that. So I appreciate that question. But even 15% is a drop in the bucket based on their potential and based on how much they're spending on dividends and adding to their retained earnings every year. So I would encourage them to do even more, but I most of all would encourage Congress to really set the standards, set a higher expectation here than that 10%. Yeah.
Thank you. Next up is another question that we got. It's where did you source your data on the Federal Home Loan Bank's affordable housing programs accomplishments, specifically on the DPA average and gap financing?
Yeah, I can look this up. I found it on a Federal Home Loan Bank website directly. So okay. I don't have the link ready, but I use the Federal Home Loan Bank as my source for these numbers. But yeah, if I can email that, email Raquel afterwards, and I can get it to you. Yeah.
Yes, we will do that. Next up. In any of the proposed legislation, specifically the Federal Home Loan Bank Mission Implementation Act, is there a carve out to support Native American and tribal communities?
Yeah, if you read it's definitely a priority for Senator Cortez Musto of Nevada. It's something that really prompted her interest in Federal Home Loan Banks to begin with when she saw how little was actually of the AHP funding and community development funds were actually spent in her home state of Nevada, including on tribal land. So it's definitely a priority for the senator. I also know that FHFA has made this a priority as well to make sure that Native American, like kind of Native American led CDFIs or trust can access the benefits of Federal Home Loan Banks better, and that it's distributed more equitably. So you can read, if you look at the Federal Home Loan Bank report at 100, there's some specific language in there too about what FHFA is planning to do on this issue.
Great, thank you. We do have two more questions right now. Will the increase to 20% potentially restrict liquidity and create a credit crunch, or have public impact in that capacity? And are the members also exempt from taxes? Let's see. I'll pause there and just say, if so, could that be changed so that revenue is created to help pay back some of that subsidy based on member interest?
Okay, it's a complicated two-part question.
Many parts.
So the first, sorry, can you repeat the first
question?
So
let's do that. Let's break it down. So the first part is, will the increase to 20% potentially restrict liquidity and create a credit crunch, or will it have a public impact in that capacity?
It will not. So in fact, from one of the reasons that the coalition supports 30% in AHP rather than 10% is that from 1989 to 2011, in the aftermath of the savings and loans crisis, Congress required the Federal Home Loan Banks to pay back to pay Ref Corp obligations to kind of pay back to some of the debt that was incurred in the savings and loan crisis. So they actually paid 20% of their income every year from 1989 to 2011 on top of the 10% AHP. So they have already shown that they can sustainably function with 30% deductions from their profit every year. I also think that the slides on retained earnings and the fact that they're sitting on $23 billion in capital on top of the sort of safety and soundness requirements of FHFA show that there's a lot of money floating around in the system, right? So there's not going to be a crunch. I don't even think that they have to reduce dividends if they don't want to do that. I think they don't have to do that. There's space there. So I don't foresee a liquidity crunch in that sense.
Second part of that question was, I think you went over this. Are the members? Let me go back to that 1 second. Are the members also exempt from taxes? And if so, could that be changed so that revenues created to help pay back some of that subsidy based on member interest?
So members are not exempt from taxes, right? So members include Bank of America, Chase, big life insurance companies, credit unions, right? So they have their own regulatory and kind of tax requirements. So they're not exempt from taxes. When I'm talking about a tax exemption, it really applies to the federal home loan banks themselves, not to their membership. Yeah.
Okay. All right. Let me go back. I think there was one more question. Actually, 2 more questions. Could you talk more about how the affordable housing program could better support regional housing needs? So with 11 districts, each with their own district needs identified in their targeted community lending plans, is the regional approach to supporting affordable housing not effective?
Is the regional not effective? So the question really is how can AHP be even more effective, right? And I think a lot of that FHFA is trying to get at with their new RFI, which is really about, what does it take to apply for AHP, right? Like, does it make a difference when you're an affordable housing developer? Does $12,000 in gap financing at the very end, does that make you do the project or not, right? Is that the best way to spur housing supply in your region? So I think it's important to get a lot of public inputs on this question, especially from people that deal with AHP directly. But based on my conversations with people, I think there's a lot that can be improved. And I think there's a lot more resources that can be devoted to this, also from within staffing at the federal home loan banks, to really make this a priority, not just sort of an afterthought of, oh, we also have to spend 10% AHP at the end of the day. So I think prioritizing is even more, and soliciting more inputs from regional players could be great. Yeah.
Great, thank you, Sharon. Another question. So we got a couple more coming in. This is great. Thank you so much. I understand the need for the federal home loan banks to support housing and community development issues across the country, but is allocating 30% to the AHP the right approach? Could increasing the AHP to 15% be sufficient, and then direct the banks to use the additional 15% to support other affordable housing needs to households at or above 80% that the AHP cannot support, therefore? Is this more effective? Yeah, sorry. And it says U.S. territories, Alaska, and Hawaii have many households that cannot be supported with the AHP due to the income restrictions.
I would tell the writer of this question to expand it into a comment letter to FHFA. I think they would love to hear about this. I think it's a really interesting idea. Like, say we raise mandatory AHP to 30%. Well, maybe that new 15, that top level 15% should be kind of devoted in different ways, more creative ways. I think that's a really good insight. But yeah, I would urge them to write to FHFA about those ideas. This is the time that we're all kind of thinking about ways to make the system better. So I think the best way to do that is kind of put our brains together and solicit ideas.
Absolutely.
Yeah.
And with 2 comment letter periods coming up, this is a good time, as you said, we have another question coming in from Spencer Widget. What uh, what are some of the proposals related to streamlining the AHP application process? How are you collecting input about common complaints with the grant application?
Yeah, so the AHP RFI just came out last week, so I've been busy. I've been busy with the first RFI on mission. We're really pulling it together. So we haven't really had a chance to sit around the table to kind of think about the second one. But I like the idea of sort of having a system to really solicit that input to put into a comment letter. But yeah, I haven't gotten there, I have to admit. So yeah.
So some ideas for you.
Yeah.
Next up, are there any other member types that your coalition wants to see added to the Federal Home Loan Bank eligibility or removed from eligibility?
Yeah, so as I said, this would be the decision of Congress. It wouldn't be the decision of FHFA to restrict membership eligibility to specific members. I know that there has been some talk about independent mortgage banks, considering that they're doing the majority of home lending right now. A lot of the members of the Federal Home Loan Bank are not even into they're not doing mortgage lending at all anymore, right? So it's sort of questionable, well, what's exactly their relationship to kind of the sort of liquidity for home mortgages, right? Which is how the system started. But the coalition does not really take a position on the independent mortgage banks. We have had discussions about the question of insurance company membership and sort of life insurance. It's mostly life insurance and property and casualty insurance companies. It remains the question if they're doing enough for housing and community development to sort of merit access to advances. What we are lending on right now is that we think as long as they are members, let's use access to advances as something that we can help incentivize to do even more. So say, hey, that's great, you're a life insurance company. Show us what you do for affordable housing and community development every year. Are you investing in light tech credits, for example? Right? If you're property and casualty, are you giving out? Are you underwriting property insurance to affordable multifamily developments? This is a big issue right now. A lot of affordable developers cannot find affordable property insurance, right? So if you want to benefit from Federal Home Loan Bank advances, show us that you're making a difference and are underwriting insurance for those properties, right? So the way that we're thinking about it right now, it's like, let's keep the big tent, but really use it to incentivize members to do more. Yeah.
And Sharon, just another segue on that question. This is actually one of my questions, and that is, you talked about the CDFIs becoming eligible in 2008. Are you surprised by the amount that is being allocated, or at least that they're utilizing in their own programs? I think it was about 1%.
So yeah, the 1% of members are CDFIs right now. So it's a very low number. A lot of CDFIs, I think it's maybe only 70 CDFIs across the whole system are members, and then maybe around half of them actually have access to advances. So it's very much underutilized for CDFIs. They've indicated a lot of difficulty getting access to advances. For example, the sort of unusual types of collateral that they have are not being accepted at all, or they're being charged a really high haircut. So they're being charged more. They have to put up more collateral basically to get access to the same loans, the same advances. So they're having a lot of trouble to actually effectively use the system. So I think this is also FHFA has indicated this. It's a priority. How can we make access to the system more easier for CDFI so they can actually use the liquidity for their community development and housing activities? And I think there's a lot of potential there, and the Federal Home Loan Banks are recognizing this themselves too. I think there's a lot of goodwill to try to work more with CDFIs. So I think if you're associated with a CDFI, it's a good time to reach out again, maybe to your regional Federal Home Loan Bank, and sort of, start that conversation again to see if it could work this time.
Absolutely, with very high mission, of course.
Yeah.
Last two questions, and we'll sort of wrap our Q&A. This is maybe a common question. Maybe the system is more broke than this discussion anticipates, and the idea of tweaking money flows around the edges are not enough. Does CFA have more fundamental changes that would drive local capital for local housing decisions?
They mean outside of the system altogether, or within the Federal Home Loan Bank system? Yeah. I mean, you didn't ask the question, so you don't know that.
Yeah.
I think that's an interesting point. I mean, right now, there's a lot of momentum around reform. So let's start with this $1.2 trillion system and sort of, steer the ship a little bit so it does more for housing. But yeah, I agree. We're dealing with housing supply crisis in general. We need to do more to kind of support affordable developments, right? So to really move the needle here. So the Federal Home Loan Bank system, it's one solution that we're pursuing, but it's not going to solve this crisis by itself. Yeah.
And Eric did come back and tell us it was outside of Federal Home Loan Bank.
Yeah.
All right. And lastly here, and again, thanks for all the questions, everyone. We really appreciate the conversation. The last question here is, does CFA have any suggestions to improve the community support program?
Community support program. I'm not the person who's specialized in that. I know that there's the CIB, and there's also community like advances specifically for community investments. All I have to say about that is that they're very small. They're small right now. So again, I think there's also an AMA program, which is about sort of Federal Home Loan Bank buying mortgages of the books of their members directly, to provide sort of an alternative secondary markets, especially I know among credit unions, this is very much valued because they may not have access to Fannie and Freddie as a smaller institution. I think they contain the seeds for even more impactful, bigger programs, right? Because AMA and the Community Impact Program, like these are all very small, and they're marginal to the sort of and the overall books of the Federal Home Loan Banks that we're talking about here. But yeah, they are essential, I think, to in reform and thinking about solutions. Yeah.
Yeah, there's just a comment here about the community support program. They're just sharing with us that it requires members to verify their CRA status and commitment to serving first-time home buyers via community support statements, just to help clarify that a little bit more.
Right.
But thanks so much, Sharon, one, for your presentation, the information, and then just the discussion. And thanks to our attendees today for helping to provide some of that discussion with your questions. So we're wrapping up Q&A. We're going to now segue into our policy updates. And so my colleague, Jenny Brown, is going to provide us with some regulatory and legislative updates so that we can finish up our call. So with that, Jenny.
Awesome. Thank you so much, Raquel. And thank you, Sharon, as well. Yeah, so I just have a few updates for you all. So this week, Treasury, has announced a host of measures to lower housing costs through increased access to affordable supply. And I'll go ahead and put in just kind of their latest announcement, but one notable measure is that this includes a new program through the CDFI fund that would provide $100 million over 3 years to support increasing affordable supply. NCST and the Homeownership Alliance are thrilled with this announcement, as we wrote a letter to Secretary Yellen in April requesting that the department do more for affordable home ownership. And I'll also plug in that letter that we sent off to Secretary Yellen. But NCST's president, Chris Tyson, was also quoted in a Reuters article discussing the impact of this announcement. And so we got some coverage there, so I'll share that as well in the chat, and you can find all this here just streaming as I put off these updates. But thank you to all the Homeownership Alliance members on the call who actually helped and secure this advocacy win. An update on the Neighborhood Homes Investment Act. So as you might be aware, NCST co-chairs the Neighborhood Homes Coalition, focusing on bringing the Neighborhood Homes Investment Act into passage. And we continue to see bipartisan momentum in both the House and the Senate. And so, this shows that affordable homeownership is becoming a higher priority for Congress. As a reminder, our strategy is to generate as much buzz and awareness around this bill as possible so it can be considered for passage in the tax package that lawmakers need to prepare in 2025. So if you're interested, you can please fill out a contact form if you want to learn more about the legislation or would like to join the coalition. And I'll go ahead and plug that information in. But just on a regulatory advocacy front, our policy team is hard at work developing responses to a number of proposed rulemakings and requests for information. The Homeownership Alliance's two top regulatory priorities, the Home Investments Partnership Program and the Capital Magnet Fund, are open for public comment. And put in that comment. And so with the Capital Magnet Fund, the comments are due on August 26th. So we'll be working on that. And the FHFA has also released a series of comment opportunities to help shape the mission of the Federal Home Loan Banks. And we get to opine on the affordable housing program and solicit feedback on duty to serve plans. So we'll plan to submit a comment for those items as well. For the Homeownership Alliance, to ensure all of our advocacy is rooted in that practitioner perspective, NCST manages coalition of nonprofit organizations focused on affordable homeownership called the Homeownership Alliance. So we are a 20-member organization and actively recruiting. NCST's policy team is putting together the Homeownership Alliance's on the ground expertise to shape up federal home ownership policy. Particularly, we are completing comment letters for home, CMF, and FHFA. So interested in learning more about that, please just fill out a form on our website, and I will put that also within the chat. But if you have any questions for me or any questions or feedback on any policy items, feel free to reach out to me as well, and I'll put in my email within the chat. But thank you all again for joining us today. And thank you again, Sharon, for your incredible work advocating for reform at the Federal Home Loan Bank. And I just wanted to say thank you so much for your time. We know, we all appreciate it, and the discussion was incredible.
Thanks for that, Jenny. It was just a very, very dynamic call, lots of information. That's one thing we can do, is connect you with a lot of our work and our partners. So please keep us in mind if you have any questions. I did want just to reiterate that we do provide copies of the presentation from today, as well as a recording on our website. It will be up within about 24 to 48 hours. If you have any issues finding it, let me know. And just a reminder before we wrap up, for our next month's call, keep in mind we are back to our third Wednesday. We had a change just for June as we were celebrating Juneteenth, but next month's community impact call will be taking place on Wednesday, July the 17th, same time, same place. So thank you for joining us again. Have a great rest of your week, everyone. Bye-bye.
Thank you.
Thanks.